Welcome to vTalkInsight, Market Drivers Daily for March 4th, 2026. The Iran conflict has moved from a regional flashpoint to the main driver of an energy shock that is rippling through equities, credit, and currencies. Today we unpack how Gulf disruptions are reshaping inflation risks, where credit stress is starting to surface, and why volatility is spiking even as some benchmarks remain near their highs. Geopolitics around Iran is now the central macro anchor for markets, with energy the main transmission channel. Over the past few days, the effective closure of the Strait of Hormuz and repeated strikes on regional infrastructure have turned what began as a tail risk into an ongoing energy shock. Risk premia that started to rebuild earlier this week are now feeding directly into oil, European gas, bond yields, and cross-asset positioning, while political debate in Washington over a war powers resolution underscores that the trajectory of U.S. engagement is still fluid. On the ground, U.S. and Israeli forces have established uncontested control of Iranian airspace and shifted from broad bombardment to more targeted precision strikes, degrading Iran's air, naval, missile, and drone capabilities. Regional partners from Jordan to the Gulf states are intercepting Iranian drones and missiles, yet asymmetric threats to shipping and soft targets remain. The Strait of Hormuz is effectively closed, tanker insurance has been disrupted, and recent attacks on vessels and attempted strikes on Saudi infrastructure, including the Ras Tanura refinery, highlight how vulnerable energy and logistics assets remain even with superior air power on one side. Energy markets are internalizing this risk through both spot prices and volatility. Brent crude has risen roughly 3% to almost $84, more than 40% above recent lows, with around $19 of that level attributed to war risk related to Iran. European natural gas prices have surged around 70 to 75% since the conflict intensified, echoing the stress seen in 2022. And European gas this week alone is up about 70% amid fears over disrupted flows through Hormuz and wider Gulf shipping lanes. Scenarios now range from oil drifting in an $80 to $90 band if disruption eases, to Brent testing $100 to $120 if Hormuz remains impaired and attacks on energy assets persist. The macro impact is highly uneven across regions. Europe and the UK, as large energy importers, look most exposed. Estimates suggest that if oil and gas stay elevated for a full quarter, Eurozone inflation could be pushed roughly 35 basis points higher, while recent upside surprises in European inflation data are already pressuring local bond markets. European yields are climbing as traders factor in a possible European Central Bank hike and scale-back Bank of England cuts, and sectors like European luxury, chemicals, and energy-intensive German industry face renewed earnings headwinds, even as European energy stocks and UK indices with heavy defensive and energy weightings show relative resilience. By contrast, the U.S. enters this shock as a net energy powerhouse with record oil and gas production and strategic reserves, while China is seen as relatively resilient thanks to diversified supply, inventories, and rerouting capacity, shifting more of the inflation and growth risk toward Europe, Japan, and other major importers. Geopolitics is not just about the battlefield. It is spilling into trade and policy architecture. U.S. threats to sever trading ties with Spain over its Iran stance, and a proposed 15% global tariff, raise tail risks around the EU-U.S. trade deal, and have already triggered bouts of weakness and underperformance in Spanish equities. Inside Europe, diverging responses to U.S. policy on Iran and open discussions about expanding nuclear deterrence signal a more fragmented, assertive security posture, while in the U.S., a Senate vote on limiting presidential war powers over Iran highlights domestic constraints that could alter the conflict's path and its market impact. Despite the alarming headlines, several forces are capping how far markets are willing to extrapolate the shock. Global crude supply is currently ample, with significant inventories, spare capacity in key producers, and strategic petroleum reserves in the U.S., Europe, and China acting as buffers, even if those reserves only provide a temporary backstop. Oil futures curves show only modest increases for longer-dated contracts, and some analysis expects that once hostilities taper and risk premia fade, crude could fall back below current levels. Policymakers, including Federal Reserve officials, have so far framed the oil move as unlikely to drive a sustained spike in core inflation unless prices move much higher and stay there for longer. There are even tentative signs of diplomatic feelers from elements within Iran, though leadership uncertainty and skepticism on both sides keep the escalation far from assured. For multi-asset portfolios, the key question is whether this remains an energy-led inflation scare or morphs into something closer to stagflation, especially in Europe. If oil were to remain in triple digits for weeks or months, history suggests both equities and bonds could sell off together, weakening the traditional diversification benefit and putting a premium on real assets and other hedges. At the same time, current pricing still leans toward a relatively short disruption, with equity markets outside the most exposed regions proving surprisingly resilient. The main watch points now are the duration of the Hormuz shutdown, any further strikes on energy and transport infrastructure, the tone of U.S. domestic politics on Iran, and how central banks adjust guidance if energy-driven inflation persists. Those same inflation and policy uncertainties are feeding directly into credit markets, where private lending and liquidity structures are the next pressure point. Credit stress today is most visible in private markets, particularly in large direct lending funds, even as public credit still looks functional. Private credit has grown from roughly $300 billion to around $2 trillion over the past decade, becoming a core funding source for mid-sized companies as banks have pulled back. That growth is now colliding with higher rates, an energy shock, and questions about liquidity promises, creating a test of both fund structures and underwriting standards. Recent moves by flagship vehicles underline the strain. One major private credit fund has seen record redemption requests in the region of $3.8 billion, prompting senior executives and the firm collectively to inject around $400 million of their own capital in an effort to reassure investors. Retail investors have become notably more nervous about private credit exposures, while institutional clients remain largely committed, creating a split in risk appetite. Managers broadly agree that gating withdrawals can be necessary to avoid forced selling, but there is clear reluctance to be the first mover because of reputational risk, so several funds are instead selling some of their best-performing loans to meet outflows, leaving remaining portfolios with a higher tilt to riskier assets. Beneath the surface, stress is concentrated in specific segments rather than across the entire asset class. Direct lending to software companies has often involved leverage as high as 20 times EBITDA, far above typical public market norms, and is now facing both rising rates and business model disruption. Industry leaders warned that defaults in this pocket could reach up to 15% in 2027 and 2028 as large loan maturities hit and capital to refinance dries up. As liquidity tightens, some private credit funds are reportedly offloading higher quality loans first to raise cash, which may leave their portfolios increasingly dominated by highly leveraged software names and smaller borrowers with more fragile cash flows. For now, most observers still characterize these issues as a shakeout rather than a systemic crisis. Liquidity remains available for high-quality borrowers. Credit markets, more broadly, are functioning, and past gating events historically have tended to contain losses to affected investors rather than transmit across the system. Institutional allocators, including pensions, are expected to maintain or even build exposure to private capital where they see strong risk management, while exchange-traded structures in investment-grade private credit have shown relatively robust liquidity and price transparency. At the same time, there is concern that standard financial conditions indices understate tightening because they largely ignore stress in private credit, and that an energy-driven inflation shock, coupled with higher long-term yields, potentially toward 4.7 to 4.8% on the 10-year Treasury, could act as an accelerant for weaker structures and over-leveraged borrowers. Looking ahead, Key markers will be any announcements of redemption gates at prominent funds, realized default trends in software and other highly leveraged sectors, and how quickly upcoming maturities in the 2027 to 2028 window are addressed. Manager selection, liquidity terms, and sector concentrations are likely to be critical differentiators, with larger, diversified platforms that have restructuring expertise well placed to absorb market share as conditions normalize. As credit spreads react to these dynamics and to the evolving oil shock, stress in private markets is already feeding into broader volatility, most visibly in Asian and European equities. The most dramatic expression of current volatility is in Asian equities, where geopolitical headlines and energy fears have collided with positioning in high-growth sectors. South Korea's Kospi index has suffered an unprecedented 12% single-day drop, following a 7% decline the previous session, effectively unwinding much of its earlier rally driven by enthusiasm around artificial intelligence-related names. Authorities in Korea are preparing potential intervention as deleveraging sweeps through the market, and across Asia more broadly. Equities have just experienced their steepest sell-off in nearly a year as the Iran war and surging oil prices trigger a broad risk-off move. This volatility shock is not confined to Asia. Equity markets in Europe, Japan, and a range of emerging markets are down 5 to 6% in recent days, while European indices had already logged a 4.5% weekly decline before stabilizing as some investors selectively bought back beaten-down sectors. Oil and gas markets are also seeing sharp swings as Brent briefly pushed above $85 before pulling back on tentative de-escalation headlines from Iran, only to edge higher again as those reports were denied. Dispersion trades that were popular in equities, such as long industrials and short software, have come under pressure, undermining the range-bound stability that supported index-level calm earlier in the year. Even Bitcoin and other crypto assets have been pulled into the cross-currents. They have rebounded and at times outperformed equities as some see them as borderless safe havens, but others warn that frothy positioning and potential spillovers from commodity volatility could quickly reverse these gains. Under the surface, classic flight to safety patterns are visible. The U.S. dollar remains strongly supported, with expectations for euro-dollar drifting toward 1.15 in the near term and oil importing currencies, such as the yen and several emerging market units under pressure. Central banks in India and Indonesia have intervened to stabilize their currencies after higher oil prices stoked inflation fears, while bond yields globally have moved higher as markets reprice the risk that an energy shock keeps inflation elevated and delays rate cuts. For portfolios, that raises the risk of episodes where both equities and bonds decline together if an oil-driven inflation surprise emerges, reducing the effectiveness of traditional diversification, even as many investors continue to add to cash, gold, and shorter duration fixed income as volatility buffers. At the same time, there is notable resilience in some parts of the market. The S&P 500 is only modestly below its highs. Futures for major U.S. indices are often pointing to gains, and investors have been quick to buy dips, helped by still supportive underlying economic data and relatively contained credit spreads. European markets, after their sharp weekly declines, are seeing selective bargain hunting in travel, leisure, and other beaten-up sectors, while UK equities have benefited from heavier weightings in defensives, energy, and aerospace and defense, positioning them as a partial hedge in risk-off episodes. Overall, price action suggests that markets are still leaning toward a scenario where the Iran conflict and associated energy shock are disruptive but not lasting, which leaves them vulnerable if escalation proves more prolonged than currently assumed. Key catalysts ahead include incoming U.S. labor data, any concrete moves toward or away from a ceasefire, and potential policy interventions in highly stressed markets like Korea. To wrap up, the Iran conflict is keeping a significant risk premium embedded in oil and gas, with Europe and other major importers bearing the brunt through higher inflation, weaker earnings prospects, and choppy equity markets. Private credit is emerging as a focal point for stress, particularly in highly leveraged software lending and funds facing heavy redemptions, though conditions are still framed as a sectoral shakeout rather than a system-wide crisis. Volatility has spiked across Asian and European equities and in energy markets, even as U.S. benchmarks remain relatively resilient and many investors lean on cash, gold, and shorter duration fixed income as buffers. The path of Hormuz disruptions, central bank responses to energy-driven inflation, and the evolution of private credit defaults will likely define the next phase for cross-asset pricing. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.